It's been a terrible environment for value managers. We're probably 10 years into a huge level of outperformance for the growth style versus value. It kind of feels a little bit like just before the tech boom, around the tech boom in 2000. We've had a couple of spikes of value outperformance. We've had the taper tantrum in 2013. There was maybe a bit of a rally when Trump was elected in the US. We've had a couple of sharp reversals this year as well. Maybe in September was a one. So value is threatening to come through, but it hasn't quite yet. Value is highly correlated with bond yields. So for me, looking forward, bond yields are at historical low levels and they're bouncing off those historical low levels. So for us now, looking forward, there's a huge potential for value to snap back. And when value does outperform, it tends to be quite quickly and quite strong as well. So we're well prepared to capture that when it does. Brexit's obviously a huge risk and a dark cloud over the UK. It's creating volatility in the UK, but it's also creating huge disparities in valuations. So for us, as well as being a risk, that's an opportunity. So to give an example, there was some data recently where it was looking at the PE ratios of GBP earners and US dollar earners in the UK index. The US earners have been re-rated positively from around 18 times pre-Brexit to around 21 times. The GBP earners have re-rated negatively from around the same level, from around 18 times pre-Brexit vote to around 8 times. So for us as value managers, that's a compelling opportunity. So we've been taking profits from some of the stocks that have benefited from Brexit, so some of those foreign earning stocks, and we've been recycling that capital into more domestic UK-focused mid-caps. And we think this is a really strong opportunity for those stocks. Maybe not for the short term, but for the mid to long term, then there's some compelling opportunities there. Yeah, we've purchased 2 new stocks in recent months. So one in the UK, UK equity Purple Bricks, which hopefully should be a well-known stock to people now. Launched in 2014, 2015, but the brand awareness has been raised significantly due to a large marketing campaign. It's had its problems over the years, so it's achieved a 4% share of the UK estate agent market. It's targeting 10. What they did though is the old management team were old style estate agents. They spotted an opportunity to move into the online arena and to benefit from technology. But what's happened is they've also expanded into the US and Australia, and they're quite distinct property markets, and the model didn't work. They've now got a new management team. The old owners have left. The new management team are from Money Supermarket and Just Eat, so they know how to build a tech business. The focus is to build that tech platform, keep costs low, leverage on that brand awareness, and to dig deeper into the estate agent market, because we feel that going forward, there's no need for branches anymore. All the stocks are advertised, all the properties are advertised on Rightmove. Everything can be done electronically. They've developed an app where people can book viewings, etc., book offers 24 hours a day. So we think this industry is ripe for disruption. We think people are looking backwards at the problems Purple Bricks has had in the past, and we think this is an excellent opportunity to get through in what could be a disruptor at a valuation that's incredibly cheap. The second one is a fund in Japan. So we bought Marantite Fuji Yield. So as value investors, we're looking at other value managers. In Japan, value has sold off quite significantly. We've found a fund that has got a 20-year plus track record. The team they've all worked together, 6 portfolio managers, all with experience in excess of 25 years. The track record since inception of the business is excellent, even though value hasn't performed quite well, the funds have. They focus on investing outside of the index, which again, for us, we've had some compelling opportunities when you move out to where the main flow of all the passive money is. The price to book on the portfolio is less than 1, but a key focus of the managers is looking at a strong business franchise or a strong balance sheet, and they're buying that with a price to book at less than 1. And that's something that's quite rare in most other markets, but because they're looking further down the market cap scale, they can find these opportunities. So for us, it's a similar business to how we look at things and how we run things, benchmark agnostic, capacity constrained, and just going out there seeking the best opportunity. So for us, it was an easy addition to the portfolio. So specialist asset allocation is mainly investment trusts. So in addition to the NAV move and the share price can move at a discount and a premium as well. So there's 2 dynamics there. Within specialist assets, we've seen a lot of movement in the infrastructure space, particularly renewables. Now, the majority of our exposures there have done particularly well. I've grown the dividend and had capital growth as well, but also these are so popular now. They're trading at some of them on average 15 to 25% premiums So for us as value managers, this is time to take money back off the table. So we've retreated from some of the renewables exposure in the specialist asset bucket, and we've allocated it to other areas of specialists such as the royalties and property. Now within property as well, we've made some changes. One is London Metric, which is a niche property manager that's focused mainly on those distribution centres that Amazon use, the kind of last mile huge distribution centres. Now given people's perceptions of where retail is going and more online, those distribution centres have appreciated in value, and also the trust has as well. So the trust NAV was trading on a 30% premium. Sorry, the share price was trading on a 30% premium to NAV. So again, that's an opportunity to take profits, and we've recycled that money into Eddiston, which is focused on office space and retail parks, or out of town retail parks. So we appreciate there's problems in the retail sector, maybe in town centres and the high street, but there's strong opportunities in certain niche markets. So the out of town retail parks, we think, has still got an attractive proposition. Free parking, you can get your packages delivered there. Every time I go to one of a weekend, you still struggle to find parking specs because they're still that busy. So for us, we still think that if your stock selection is right in that space, and we've recycled from London Metric, which is a 30% premium, to Eddiston, which is trading on a 20% discount because people have factored in its retail exposure and given it, we think, an unfair discount. So that's a useful story of what we've been doing in the property sector. It's evolved exactly how it has in previous years. So we're now in the 10th year of one of the biggest bull cycles that we've had. We've been de-risking the portfolio for a number of years now, and we've continued that into 2019. So the key assets allocation change we've made has been reducing equity, and we've added an allocation to gold and increased that allocation to gold. And that's probably something that we will continue to do over time as well. Our main focus at the moment is looking at what's going to happen next in the cycle, and we think that's going to be a downturn. And we need to make sure the portfolio is, one, well diversified, the income is well covered, and we've got enough sufficient defensive assets in there and asset classes to cover that period.